Yo, what's up, you guys? Welcome back to another video. Today, I want to talk about interest rate decisions, how you can use it to make some very good trading decisions in the market as well. We're going to talk about what it is, how do you analyze it, and what does it mean for you as well. Without any further ado, guys, let's jump straight into it. I'm not going to go over any questions. I will cover them in the video for tomorrow. So interest rate decision, right? We know that that's coming through tomorrow for the US, and a lot of people is probably going to start talking about it on Instagram, start selling account management courses that you can enroll into, and brokers are going to talk about the FOMC competition and all of that stuff. But the interest rate is obviously, it basically means one thing. The interest rate is when you go to a bank and you ask the bank to borrow you 1,000 rand, right? This is the simplest way to explain interest rate. Is when you borrow 1,000 rand from the bank, and whatever fee the bank charges you on there, it could be 3%, 4%, 5% per month. That's what you initially need to pay back. So if you borrow 1,000 rand from the bank and the bank says you need to pay us back 1,500 rand, you can look at the 500 rand as the interest that you need to pay for borrowing the money. Now, interest can be negative and it can be positive. Positive interest rate normally affects people that takes their money and put it into the bank, right? People who invest their money into the bank, they normally get a positive return of anything between 7.5 up to 11% per annum. That's per year. Now, that's positive interest rate because, that's positive interest because when you deposit money into your bank account, that money occurs interest and then you get paid that interest. But if you take the bank's money, then you have to pay them interest. If the bank takes your money, they have to pay you an interest. Now, interest obviously in most cases negatively impacts the consumer more than it does the bank. Now, why do I say so? If I take 100,000 rand to the bank and I say I would like to invest this for the next 12 months, the bank is going to take that to 100,000. They are going to give me a 12% interest over the next 12 months. What they're going to do is at the end of 12 months, they're going to pay me 12,000 rand in profit because that is my 12% interest that I was going to get for them taking the money. Now, you probably think, okay, but how is the bank going to make money? The bank takes that 100,000, they'll take a 20,000, they'll put it aside, they'll take a 80,000, and they'll borrow that 80,000 across the floor to a lot of people. Each person that they borrow to has got an interest rate attached to it that is probably 10 or 20 times higher than what you're going to get by the end of the year. So when they pay you out your 12,000 by the end of the year, they would have probably made a couple of millions off your 100,000 that you have deposited. So they have no problem paying you 12,000 interest because they've already used your money to borrow it out to other people. Now you might think that that's a Ponzi scheme. Well, it's more like a legal way because it's a central bank and all of that money stays within the banking system. Now that is interest rates, right? Interest rates tend to increase. The only people that generally benefits from higher interest rates is investors, which are the people who puts their money into the bank. So if you put your money into the bank and the interest rates increases, that means the bank is more likely to pay out a higher interest to you. However, if the interest rate increases for the person that had borrowed the money, that then negatively impacts them. Why? Because that means they would be paying back the bank more compared to what they have paid based on the initial agreement. So you go to the bank, borrow 1,000, they give it to you at the 5% interest. That 5% interest now increases. Now you need to pay the bank back slightly more than what you have borrowed. So now you need to pay the bank 1% more compared to what you were paying. And the higher it goes, the more you have to pay back. This person here who has deposited their money, they've got a fixed interest because the bank obviously don't want it to go up. So they give you a fixed interest of 12%. Now we know what interest rates are. Let's talk about CPI or consumer spending index, and I'll show you exactly how these two they work hand in hand, right? Now the CPI is called the consumer spending index. This index is measured to use inflation. It's used to measure inflation obviously the what consumers spend on a basket of goods and services, what they spend on food. Now, this is a key indicator that investors use when they want to determine whether or not inflation is high or low. Now, the Fed's job at all times is to do what? They have to make sure that they bring down the inflation. Inflation is CPI can be seen as inflation, right? Now, when the Feds come through and they see that inflation is on the rise, or there's a fire coming out of inflation, the only way that the Federal Reserve is capable of bringing down the inflation is to hike interest rates. Now, to give an idea how this works, when inflation's low, right? Back in 2020, the US Feds brought the interest rate to zero. This had consumers running to the bank to make a lot of debt. So inflation was very low, interest rates were low as well. So because of this, the Feds, they lowered the interest rates. This, inflation was also down. But then what happened was people were flocking to the bank and they were taking out loans. Why? Because we had a 0% interest rates over here. If you're on my Instagram, you'd have seen that story that I published on there. When the interest rates are at zero, you have consumers running to the bank and they're taking out debt. Why? Because interest rates are lower. At that point, the consumer would then be paying back 1,000 Rand. Okay? Now, think of it in this way. If a consumer earns, let's assume the consumer earns 2,000 Rand, right? The consumer goes to the bank and they borrow $1,000. Okay, let's just work in dollars. The $1,000, and the bank says because it's a zero interest rate and you take it over 24 months, you just need to pay us back that amount. That was at that time. So let's assume that they say you have to pay back 250 Rand or $250. That means you still have $1,750 in your account. You are living the life. You got $1,000 and you've saved up, or you've got $1,000 from the bank. Now you've got a $1,700 at your disposal, right? Now, because interest rates are so low, this will encourage you to go out there and spend. You're going to spend your money on iPhones, all the kind of stuff. And because of this, because the interest rates are so low, the consumer spending index, okay, because of low interest rates, this encourages consumers to go out there and spend. Hello, will spend, tap. And because of that, now the consumer spending index will now increase, right? It will increase. It will go up. Now inflation goes. It goes because interest rates are lower. So it's the Fed's job to come through and make this spending spree difficult for the consumer. And how do they do that? They increase interest rates. All these interest rates is directly associated with any debt that was taken out in the first place. This means this $250 will increase in debt every time the Feds hike the interest rates. Thus mean at the end of the day, the amount of money the consumer will have left at the end of the month will become less and less, and they will become to spend less and less and less and less, and then that's how they would then bring inflation down. Now, you use that analogy and you apply it into the way you want to look at interest rates as well. Here's a graph from the United States Trade Economics website, and I want to show you exactly. This is the Federal Reserve interest rate. This is the US Consumer Spending Index. You can see here how how as the CPI had increased, or the consumer spending had increased, the Feds had desperately also kept on hiking the interest rates, trying to bring down inflation or trying to bring down the consumer spending, but they have had not much luck to try and do that. So the only way for the Feds to come through and make sure that they bring inflation down is to do what? They have to be a little bit more aggressive with the way they hike the interest rates at the end of the day. So as long as there is no cool down in inflation like we saw here, there is no reason for the Feds to not hike interest rates. So whenever you look at these Forex Factory data, all you want to look out for is if you see the CPI keeps going up, you can expect, if you see this keeps going up, you can expect this to keep going up as well, until this starts to cool down or go lower, or the CPI numbers, these numbers starts to go lower, then you can expect these numbers to go lower as well. Now, what does that mean for the dollar index? Now, the dollar index is obviously means that because higher interest rate, like I said, okay, when the interest rate is higher, investors gets paid out more. So that means people are more likely to invest or buy in the dollar. That means the dollar index will then increase in value because more people are likely to invest in it. As soon as the CPI number starts dropping dramatically, that means the dollar index, the Feds will bring down the interest rate, meaning that investors will get a lower return. That means the dollar index will go lower as investors will start looking for currencies that's got a higher interest rate compared to the dollar index. Now that we have that out of the way, right? So that should give you an idea of what you can expect with the Federal Reserve interest rate tomorrow. Remember, we've got a very high CPI reading year over year and month over month. Inflation has showed no signs of cooling down. Also, because of that, I'm still biased on the fact that the Feds are going to hike the interest rate until, like I said before, we need to see some signs of inflation cooling down. That says here that stocks fluctuated as traders braced for a hawkish tone from major central banks responding to the persistent inflation pressure in policy decision this week. So that already gives us an idea that they can see that inflation is nowhere near cooling down as well, and there is still a lot of room for inflation to continue higher. Then because of this, the Feds has no other choice but to keep hiking these rates until they actually tame the flame, until they brought the fire under control. Yes, so that is a very easy way for me. I hope you guys understand what I was speaking about, because I know. But please, if you don't understand or if you have any questions, just drop them down in the comment section below. If you did enjoy the video, a sub to the channel would be appreciated, and do like the video so we can get more people educated as well. That is it from my side, guys. Thank you for your time, and please do not trade FOMC and all of that stuff. It's gonna get you nowhere. Thank you for your time. And as always, cheers for the years.